So what I'd look to do, Mark, is to present on Galliford Try for around about 15 minutes or so, and then go to Q&A as you suggested. So just to begin with, we are very, very pleased with our half-year performance through to 31st of December 2021. I'll just pick up some headlines on this slide, all of which I'll come back to the themes later on in the presentation. So as you can see, we're making very good progress on our strategy. All of our key metrics have improved in the period under review. So profit is up, our profit margin, more importantly, is up, and our dividend has also increased. We made an acquisition in October 2021, and we're integrating. That integration is progressing very, very well indeed. So I'll come back to that acquisition later on. We continue to focus on the core disciplines in the business and focus on risk management, the key foundations that we've established over the past few years. And that's also allowed us to manage inflation very effectively through the last few months of higher inflation. The order book, and in particular as well, the pipeline of work that we're tendering for at the moment, that order book is very, very strong. And so we're confident that we're well on track for our strategic targets to 2026 that we set out in September of 2021. So just to come to the half-year performance in a little bit more detail. So we had controlled revenue growth in the 6 months of 10%, and that increase was across both our building and infrastructure divisions. And you can see the chart at the bottom there, the revenue growth was 3% in building and 25% in infrastructure. That growth was driven by increased water revenues, and we said last year that the water is a cyclical business, and we were in a trough last year, and that growth is as we anticipated when we announced our full year results in September. Equally as pleasing, we've had margin improvement across both building and infrastructure. You can see in the chart at the bottom right of the screen. So our building revenue has increased, margin has increased to 2.2%, and our infrastructure margin has increased to 2.1%. So that's good operational, good contract performance across the whole business, and that's really good progress on our trajectory to our 3% operating margin target. We did incur some exceptional costs in the period. None of those were contract related. They related firstly to the integration of the acquisition that we did in October 2021, and secondly to an investment in a new ERP system, so that's a commercial, financial, HR system. Ordinarily in the past that would have been capitalized and we'd spread that cost over 10 years or so. Unfortunately, we're no longer allowed to do that as the accounting regulators changed the rules, so that's now treated as a one-off cost in the period of implementation. Our relatively low tax rate due to some brought forward losses means that our profit before tax of 7.1 million translated to a profit after tax of 6.5 million and earnings per share 5.9 pence, all on a pre-exceptional basis. Equally as important as the performance of the business is the strength of the balance sheet. And for those of you who are new to Galliford Try, those of you who are already familiar, we have no debt, we've got no pension schemes, liabilities. So that means in a period of rising interest rates, that doesn't affect the strength of our balance sheet. In particular, we've got £180 million of average month-end cash on the balance sheet. That's increased over last year, and that's been driven by strong collections performance, because equally importantly, we've improved again our payment performance to our supply chain. And we now pay 98% of our invoices within 60 days, and our average days to pay are 25 days. So very, very good payment performance to our supply chain. And at no time during the 6-month period did our daily cash balance fall below £100 million. So that cash balance, allied with the PPP assets of £48 million, provides us a real strong platform to grow the business. So how do we look to use the balance sheet? Well, firstly, really importantly, the board continues to prioritise maintaining that strong balance sheet. So just to work through this slide in a little bit of detail, the strong balance sheet gives us a real operational competitive advantage in the market. It allows us to a competitive advantage in terms of winning work with clients and in terms of working with the best supply chain. So both our clients and our supply chain want to work with financially stable companies. So it's a differentiator and an enabler of our growth strategy. And that balance sheet also allows us to invest in further strategic opportunities, whether that be digital investment, investment in our people, or indeed investment in bolt-on acquisitions, such as the acquisition that we did last year, and we continue to be open-minded for other acquisitions that support our strategy. Secondly, the balance sheet allows us to mitigate risk and really focus on maintaining that discipline that we have through the business. So I guess put simply, we won't and we don't need to take the wrong contracts to chase short-term cash flow, the sort of decisions which would harm the business in 2-3 years' time. So we don't need to do that because of the position that we have. Thirdly, the strong balance sheet allows me to commit to paying sustainable, regular dividends. And what we've done in our announcement last week is we've improved our dividend policy such that we'll now commit to paying annual dividends twice covered by earnings. So in other words, we'll return 50% of our earnings to shareholders. And finally, we continue to review the ongoing cash requirements of the business. We do that in the context of the macroeconomic environment, the outlook as we see it, the other opportunities for investment that are available to us. And we said that when there is sustainable excess cash in the business, then we will also provide that as additional returns to shareholders. So putting this together, that allowed us to declare an interim dividend of 2.2 pence per share. That's 83% higher than this time last year. And as I said, improve that dividend cover policy to 2 times annual earnings, so 50% return to shareholders. And that dividend will be paid in early April to shareholders on the register on the 11th of March. So if that's a look back in terms of the results for the period, I now just want to spend a few minutes looking forward to the future. And this slide is a reminder of the strategy that we set out in September 2021. And there's 4 main strands, as you can see. So the top left quartile is our focus on progressive culture, so people-orientated progressive culture driven by values. So very importantly in there is our focus on health and safety, but also our wider people strategy focused on diversity, inclusivity, and early careers, for example. The bottom left quadrant is all about socially responsible delivery. So that's about low carbon, it's about biodiversity, it's about social value that we deliver to our clients. The top right quadrant is about quality and innovation. So that's working with our clients and our supply chain. That's about investment in digital technologies to both improve quality, but also improve the efficiency of the business. And putting those 3 things together, you get to the bottom right quadrant, which is a focus on delivering sustainable financial returns for our shareholders. So this is all about a single sustainable growth strategy for the business. So that's what we want to deliver. This slide tells us a little bit about how we're going to deliver the growth over the next 5 years. And it's worth me being very, very clear. We're able to grow the business, the top line of the business, grow the revenue because the market is there to support the growth. So we're not there to chase revenue for revenue's sake. We're there because the market is very strong at the moment. So in a risk managed and disciplined way, we can deliver revenue growth and more importantly, deliver margin and profit growth. So there are 2 main parts to the strategy and the growth strategy. The first is to deliver more through our existing markets, through our existing businesses. So we'll come on to those sectors in a moment. And the second area is to develop what we call adjacent market capabilities. So these are markets that we know and understand. They're a little bit different to the existing markets, but they provide higher margin opportunities. And I'll give you 3 specific examples of the kind of markets that we're looking at there. So the first is PRS, so the private rented sector. So we currently build a number of private rented apartment blocks for clients. What we're looking to do is to move earlier in the development cycle so we can do some of the development work as well as the construction work. And that allows us to access the higher developer margins as well as the construction margins. The second area we have is in what we call green retrofit. So we have a relatively small facilities management business. And actually what we can start to do is to grow that business into the green retrofit of existing buildings. So for example, taking a building like the one I'm sat in today, working with the owner of that building to see how they can make the building more energy efficient. That might be as simple as changing light bulbs, or it might be about changing windows, changing ventilation systems, for example, but working with the clients to retrofit those buildings for energy efficiency. And the third area is in water, and we'll come on to in a moment. You'll see water is one of our major sectors in terms of design and build contracting work. And we think there's a real opportunity to move into the asset maintenance and asset optimization parts of the water sector. So I mentioned a couple of times during the half-year period, we did an acquisition. We acquired the water business of NMCN. NMCN had unfortunately fallen into administration, so we were able to take the water business, which is a really high-quality business, for a headline consideration of £1 million. And this acquisition is fully aligned to that strategy which I've just outlined. So in particular, this acquisition brought three things to the business. So firstly, additional geographic footprint. So our previous water business operated, if you like, at the eastern seaboard of England and into Scotland. The acquisition brought us the western side, so South West Water, Severn Trent, United Utilities, and so on. So it brought additional geographic footprint, so the existing markets piece, but in additional geographies. Secondly, it brought additional capabilities. So those adjacent markets, it brought with it additional design capabilities, some off-site build capabilities, and ability to manufacture control panels for monitoring and managing water facilities across the country. So that's the adjacent markets piece of the strategy. And thirdly, of course, the acquisition brought with it 900 excellent people who've really fitted in. I think the way they've come into the business, they've rolled their sleeves up and culturally been very aligned to the Galliford Tri. So that's been a really good fit for those people that we brought into the business. We were able to execute this acquisition because of the strength of our balance sheet, and this will really help us to grow and to accelerate that growth strategy that I've just outlined. The acquisition didn't contribute very much in the half year because of the timing of when we did the deal, but going forward it will contribute in the order of 120 million pounds of turnover per annum. I said a couple of times that the market is there to support our growth aspirations, and this slide just really gives a little indication of some of the drivers of that growth, in particular in the sectors that we operate in. And it's worth pointing out that 90% of our work is in the public and regulated sectors. So those drivers, the levelling up, the climate crisis, investment in the UK economic and social infrastructure, that's very aligned to the sectors in which we already operate. And we're seeing a good pipeline of new opportunities in all of those sectors. And so that translates into an excellent high quality order book of £3.4 billion. And the components of that order book by sector are shown on the left hand side, and you can see in the middle chart that, as I said, 90% of the order book is in the public and regulated sectors. But what's far more important than the size of the order book is the quality of the order book. And just to give you a few kind of insights into the order book, so we already have 95% of this year's revenue secured and 81% of next financial year's revenue secured. So that means the order book is giving us a real strong visibility, real strong line of sight into the next 18 months worth of trading. 87% of that order book is through established frameworks. That means clients that we know, and it means established terms and conditions. And 93% of that order book is with repeat clients. So again, shows the quality within the order book. The reason we can have such a quality order book is because we have such a strong focus on risk management and discipline across the business. This is partly through processes that we have in place. It's largely because of the culture that we have in the business. So everybody across the business is aligned to the strategy that we have in place and aligned to the risk management and the risk appetite that we have as a business. So those of you who've seen me present before will likely have seen this slide before. It applied in September and previously, and it still applies. So as we grow the business, this is the risk management framework through which we'll grow that business. And this has been particularly important in the last few months to help us manage and mitigate inflation. So how do we manage inflation? I guess the key is to price our contracts properly. That means building in risk and inflation allowances into all of our tender prices, so that the inflation that we suffer is only the difference between the inflation that we anticipated and the inflation we actually experience. We also procure early, so that has the advantages of making sure we can have fixed prices for our supply chain, lock those prices in, and also guarantee availability of materials when we need them to deliver the projects. And we engage very closely with our supply chain, and that's why it's so important. I stressed the point earlier that we pay our supply chain properly and on time. We want the best quality supply chain to want to work for and with Galliford Tri. So overall, we've successfully mitigated the impacts of inflation that we've seen. such that it had no impact overall on the trading in the period, nor has it required us to adjust our strategic targets. So just going back to the overall summary slide of our strategy, it's very importantly for me, the ESG metrics, the sustainability metrics are sewn right the way through our strategy. We don't have a separate ESG strategy to our main corporate strategy. The two things are completely sewn together. And there's a number of our sustainability metrics that we only measure on an annual basis. But I've given a few indications here for the half year of some of the metrics that we do measure. So for example, of course, most importantly is accident frequency rate, so 0.07. When you look within the industry, that's a very, very credible position to be in, but as we are striving for no harm across any of our sites, and that's a journey we'll continue to pursue until we achieve that target. We've committed to having more than 5% of our employees in early careers programs. We've currently got 6.2% in such programs. We've got a considerate constructors scheme score of 41.4, which is above the industry average. And as I mentioned earlier, we've got 93% repeat clients. So those are just some of the indicators of the kind of metrics that we measure in terms of the sustainability of the business. And of course, equally important are our financial targets. You can see the 2026 targets in the middle column there. And across each of those targets, we've made good progress in the 6 months through to 31st of December 2021. So in summary, very, very good performance in the half year just ended. We're very pleased with the performance and the progress we've made against the strategic targets. We're in an excellent position in terms of our balance sheet, our order book, and the pipeline of opportunities in the sectors that we've chosen to operate in. So you put all of that together, we're very confident in our position and very confident in meeting our 2026 strategic plan. So with that, Mark, I'm very happy to take any questions that you or the listeners have got.
Thanks very much for that, Andrew. A very interesting presentation there. I'll just remind our delegates, if they'd like to ask a question, please click the Q&A button at the bottom of your screen and type in your question. In the meantime, there are a few questions that occurred to me as you were going through your presentation, so we'll kick off with those. So you mentioned that you're aiming to increase your operating margin from 2 to 3%. One of the levers you've said is by entering adjacent markets that have higher margins. What other levers can you pull to improve your operating margin?
Yes, sure. So broadly speaking, that move from 2 to 2.5%, if you like, the first half of that, so 2.5, 2.6 or so, will come through the existing order book, and will come through that in two ways. So one is by doing more through our existing businesses, so therefore, if you like, using the overhead more efficiently, so that will drive the margin up a little bit. And the second is that as we've, over the last few years, been transitioning frameworks, we've managed to improve the gross margin on some of those frameworks. So as those frameworks come on board, and if you sign a new framework on the 1st of January, of course, most of the work in that year still was procured off the previous framework, so they take a little time to feed through, but some of those frameworks have been procured off higher margins as well. So it's about choosing the right work with the right margins and growing the operational leverage, if you like, across the existing business. So that's how the existing markets piece will grow the margin. And then we see that the final tick up at the end up to the 3% being driven by those additional adjacent markets.
Right, very good. So it's greater discipline in contracting is one of the key contributors there.
Yeah, so look, that discipline, that focus on risk appetite, making sure we all understand what we're doing and making sure we take on the right contracts with the right terms and conditions is absolutely key. And we're, say that we've got the right processes on that, Mark, and that's great. But actually, as I said earlier, what's far more important is we've got an aligned culture. And you can have the right processes, but if everyone spends all their time trying to work their way around it, that doesn't really add anything. So that culture and that aligned culture right through the business. And I mean, just to give you an example, my chief executive and my our incentives are exactly the same as everyone's through the business. It's focused on margin, on profitability, and it's focused on cash. Nobody in the business is targeted on revenue, for example.
I hope there are some incentives related to safety and ESG as well.
Yes, so safety absolutely features, as the sustainability of the business, and as with lots of other companies, we're looking at how we can incorporate that even more fully.
Good. Okay, so my next question is to try and learn a little more about your client base. You've described a little bit about the sectors you operate in. I'd be interested to know how concentrated your revenues are amongst your top 5 or top 10 clients, say, and the breadth of your client base. Could you say a bit about that, please?
Yeah, of course. So our client base we're not hugely concentrated. So broadly speaking, the business splits 2/3, 1/3 at the moment between building and infrastructure. In infrastructure, the split is between highways and our environment or water business. So in water, we operate now with almost all of the UK water companies. So there's a spread across all of those water companies. In highways, we operate, probably half of highways work is with national highways. So that's looking at motorways and the major A roads. And the other half is through the local authorities. And that's more looking at, maybe local bypasses and those kind of things. So again, the highways work is spread between national highways and local authorities. In building, the work is spread between, you saw the sectors on the order book slide, which is sort of representative really of the revenue that comes through as well. So our biggest client is through education, but again, that's split between England and Scotland, of course. So about 25–30% of our business is in Scotland. The other key sectors in there: Department for Justice, Ministry of Defence, Department for Health, and again, those are different health trusts that you work with, so different clients. And then we've also got a good piece of the building businesses, commercial businesses, and that's a combination of private rented work, student accommodation, also offices as well. Again, that's a very diverse set of clients. So we do have a good mixture of clients across both building and infrastructure.
Very good. You also mentioned that you're working in areas addressing the climate crisis. Could you tell us a bit more about the types of things that you're doing that will help in that direction?
Yeah, so there's really, I suppose, in the last 6 months or 12 months or so, there's really a couple of things we've been doing. But I'll start with what our objectives are, Mark. So we've committed to net zero carbon by 2030 across our own operations. So the jargon is scope 1, scope 2. So that's things that we can control: our offices, our fleet, and so on and so forth. So and in that we're making very good progress. So our, for example, our fleet now has a carbon footprint of 66 grams per kilometre. That's down from about 133 grams per kilometre a few years ago. We're targeting to get that to 25 grams per kilometre by 2025. We now only order electric or plug-in hybrid vehicles, so you can't anymore order petrol, diesel, or traditional hybrid cars on our car scheme. 98% of what we ordered in the last 6 months was electric or plug-in hybrid, and about 44% of our total fleet is now electric or plug-in hybrid. So making big strides there. We've also committed to being net zero carbon across all of our operations by 2045. Some of you may notice that's 5 years ahead of the government target, but the 2045 aligns with the Scottish government target, and as I say, 25–30% of our work is in Scotland, so it makes sense for us to align with that. So it's a couple of things that we've done in the year. So one is around kind of governance and process. So we've appointed a new director of risk and sustainability who's driving a whole lot of governance around various of the areas. We're launching an e-learning course for all of our staff, so that will be launched later this month. So everybody across the business will be brought up to a certain level of knowledge about this whole agenda, and making sure that but sort of busting the jargon and that sort of stuff to make sure everybody in the company understands the objectives. And at the same time, we're focused very heavily on practical steps on the ground. So we've appointed a low carbon construction lead. So she's one of our previously a design manager in the business, now operating to really help us design carbon out of our buildings that we build. And effectively, there's two places that we look here. One is around the operational efficiency of a building and making sure that we can make buildings as energy efficient as possible. And then separately, and it is more difficult, I won't pretend otherwise, is to reduce the carbon which is embodied in the building and in the fabric of the building. So, but in the first place, we've built a number of very energy efficient buildings, whether that be passive house standards or net zero carbon in use buildings. And of course, one of the key things that we're doing is also monitoring and understanding how these buildings operate in practice. Because it's one thing, you can design a building to be very energy efficient in use, but if everybody leaves the doors and windows open all the time and then turns the heating up, guess what? It's not as energy efficient in practice as we expected. So one of the things that we're looking to do is to understand how buildings operate, in reality, so we can then make sure we're designing them for real use as opposed to kind of theoretical use. So we're spending a lot of time working with our supply chain, with our clients, and internally on this. We've maybe just one final example. We've got 12 piling rigs that we own, Marks. These are the things which put the big piles in the ground. We've converted all of those onto hydrotreated vegetable oil rather than diesel, and that's reduced their carbon footprint by 95%. So really huge impacts in terms of just converting those rigs onto HVO.
But are there opportunities for your business in infrastructure projects that are needed to address the climate crisis?
Yeah, absolutely. So the combination of two places. So one is in terms of new build and making sure that we're building, low carbon and carbon efficient buildings, and not just buildings, but also through water, through infrastructure as well. And also, as I mentioned, this piece that we're calling green retrofit, which is about taking existing building stock and making them more energy efficient. So if you think about 2045, I mean, it's only 23 years away. Actually, a lot of the buildings that will be existing in 2045 are already built. And so actually to hit the UK's net zero carbon targets, those buildings have to become as energy efficient as possible. So that's why that green retrofit is such an opportunity for us.
But you don't see yourselves being involved in infrastructure for wind farms, energy storage, those sort of things. That's outside.
Those are not sectors that we operate in. I mean, there will be opportunities in terms of some of the sort of second layer, so whether that be building some of the facilities and so on for those, but building wind farms themselves is not something that we do.
Okay. You mentioned in challenges of inflation and so on, which is something that all businesses have to contend with at the moment. A related issue is that of staff recruitment, retention, and costs. What are you seeing in that area? Are you finding it difficult to recruit and retain costs? Are you having to pay above inflation to retain and recruit staff?
Yeah, so we have we spend a lot of time, as you might imagine, investing in our people. Our staff churn rate at the moment has moved a little bit. It's 12.8% now, which is still very, very good in the sector. So it was about 11.8 this time last year. So that's probably just the market is very, very hot, as you say. But there's a lot of things that we look to do, right from focusing on health and safety, obviously, but well-being as well. So through the pandemic and continuing, we hold Wellbeing Wednesday sessions, which are more about mental health, very important. And those have been open not only to people working for us, but also their families. And that's particularly important during lockdown when clearly people were finding that very difficult. So really helping people there. And one of the things which is very very encouraging is the staff scores. So we did a staff survey last year. We've got very, very good staff engagement scores. 93% of our staff are bought into and inspired by the vision that we've got for the company, which is an excellent score. So our staff are very engaged. But you're right, as we grow the business, then we want to continue to develop our own talent and develop our own people and develop their careers for them, and also recruit the best people that we can find into the business. So NMCN brought, as I said, with it 900 excellent people. That's very good. We're investing very heavily, Mark, in early careers. So I said 6.2% of our staff are on early careers programs. I would actually expect that to increase through the course of this year, looking at some of the apprentices and trainees and graduates that we're looking to take on. And bringing people in early careers is great because not only does it allow us to help people grow and build a career, it actually allows us to also bring in a more diverse population of people in, in through those early careers programs, which is also really important. So staff recruitment is a really important part of what we're looking to do, staff development, working with our people. That's why, if you remember on our strategy, that's the first quadrant I referred to, is all about our people and making sure we're a place which, people want to work, feel that they can give their best and that they can develop, the best careers as well that they can have. And then similarly, we work very closely with our supply chain. We engage, we have a program we call Advantage Through Alignment, which brings our supply chain closer to the business in terms of also giving them access to our training, to our pipeline, helping them invest in their own people as well. So yeah, for sure, making sure we continue to invest in our people is really high priority.
Yes, that's clearly very important in this era. Well, thank you very much for that, Andrew. I can only assume that we have a very knowledgeable audience. They already know all about Galliford Try, as there are no further questions from the audience. So that being the case, I think we'll have to say thank you and wrap up at this point. So thanks once again, Andrew.
Thank you very much indeed, Mark. Thank you.